webinar. My name is Kylie Smart. I'm the Vice President of Customer Success and Sales at Kepler. We have 14 weeks till Black Friday. December trade commences, which is crazy to think already that we're at that time of the year. Most retailers are about to embark on Christmas recruitment and have already started to make plans to deliver a spectacular Christmas trade. And it won't be long until we start hearing Christmas tunes from Mariah Carey and Michael Bublé in the centres. So I can't wait for that. Look, in today's webinar, we're going to showcase FY24 results and the market insights, and then take a look into the future on what we're expecting for FY25. With Black Friday trading coming, we're also sharing at the end of today's session a Black Friday ebook for you to download. The report will cover 2023 results and insights for success for 2024. So stay till the very end so you can download it. Look, we encourage you to use the chat box to the right-hand side of your screen. So feel free to ask questions or say hello and tell us where you're from. For those who are brand new or just starting to embark on your traffic technology journey, to share a little bit about who Kepler is and what we do. We are a unique people counting technology, and our reach is in over 35 countries, 20,000 locations, and extending over to 500 retailers across the world. There's a Kepler Smart Sensor technology is more than just people counting. It does utilize in-store customer analytics to help you improve your customer satisfaction, increase your sales, and decrease your operating costs across your retail network. And we're not just a technology that's used by the retail team. It's very much normally used across other departments like marketing, leasing, BM, and store design, and the list goes on. But let's get into the good stuff. I'm going to introduce you to Denny French, who's our GM of Customer Analytics at Kepler. And most of you would be already familiar with him as you receive the weekly or monthly KRI insights and the commentary around what's going on in the retail market. So I'm going to now hand it over to the expert. Welcome, Denny. We're looking forward to hearing from you today.
Thanks, Kylie, and good afternoon, everyone. Thanks for joining us today. So the focus of today's session, as Kylie said, we're going to step through FY24 in review and highlight some of the key themes and trends that we saw impacting the Australian retail environment over the course of the year, and then we'll talk about what we're seeing in terms of the outlook for the first half of FY25. Just to put in context what we're showing today. So today is based on our product, our Kepler Retail Market Index. So this is a aggregation of over 2,000 stores across Australia and New Zealand, and provides a very insightful and timely view of retail performance across those two different markets. So today's insights are focused on the Australian set of stores within that, and you can drill down into a range of different performance metrics or different sort of profiles like state views, product category views, and shopping centre views, etc. I will point out that today's insights are all like-for-like store basis, so we're looking at trends across the same universe of stores across the different time periods as we go through today's findings. So stepping into, in aggregate, what the year-on-year trends look like when we compare FY24, July to June period versus the prior 12 months in FY23. From a passer-by traffic perspective, we saw quite a drop, 8% decline overall year-on-year. But that was largely offset by an increase in shopfront conversion, so the proportion of people that pass a store and actually go into that store, which resulted there in inside traffic being slightly down, but more or less flat year on year. But there were some interesting sort of trends across the year that we'll delve into in a moment. The big story really, and what drove the majority of the overall sales decline of 4%, was a drop in sales conversion. So while traffic in store was largely flat, those consumers were less likely to transact than they were the year before, and that drove transaction volumes down by 5% overall. We did see average transaction volumes lift by 1% across the year, particularly driven by the second half as price increases and inflationary impacts started to flow through into the results, resulting in an overall 4% sales decline, as I mentioned, across the year. One of the other things that we saw is that customer dwell times increased by 6%. And we think that this is possibly due to quite a lot of retailers really shifting the focus of their stores from a transaction environment to much more of a brand and consumer experience. And as a result, consumers are spending more time in store. So we thought that was a sort of an interesting proof point around what a lot of our customers and other retailers that we talk to are working on from a store of the future perspective. The other trend that we saw, and we called this out during our webinar earlier in the year, is the concept of what we've called the considered consumer. So this is a sort of more purposeful, more value-focused consumer than what we've seen sort of pre-COVID or even sort of coming out of COVID. Reduced window shopping, which is driving that reduction of about 8% in passerby traffic, and we saw that sort of consistently throughout the year, as you can see there in the graph on the right. But an increase in the shopfront conversion, 4%, meaning that people were less likely to sort of pass by a store. They were more likely to have a particular shopping mission in mind and to head to this particular store that they were interested in on that shopper mission. We also saw that increasing value focus as sale periods tended to have an increase in traffic relative to other periods of the year, and also outlets were more focused on and more sort of dominant channel within the mix of foot traffic across the year. So overall, that trend sort of cancelled each other out, as we said, and foot traffic was down about 1% overall throughout the year. When we look at each of the quarters of the year, each one sort of tells a bit of a unique and different story as to how the year progressed. The first quarter of the year was the weakest out of the whole 4 periods. Sales was down 7%, largely driven by traffic. So that traffic was down 4% for inside store traffic. Transaction volumes, as a result of reduced sales conversion, dropped that another 3%. So those two sort of drove that 7% decline in sales overall. Second quarter was a little bit better than first quarter. The overall store traffic recovered a little bit, was still down, but not as down as much as we saw in quarter one. Sales conversion was still on the weaker side, and we saw sort of a stronger focus around the Black Friday periods and, you know, consumers digging deep in the lead up to Christmas, which helped to sort of boost sales performance and result in an overall decline of 4%. As we moved into quarter three, traffic continued to keep recovering. We ended up being flat year on year for store traffic, but what we did see was a really big drop off in sales conversion, 7% decline there compared to the trend of 3% down in the first 2 quarters. It appeared like there was a bit of a hangover from Christmas shopping periods. People were still visiting stores, but much less likely to actually transact within that. The drop in sales conversion, however, was somewhat mitigated by the effects of inflationary impact starting to flow through. Overall transaction volumes increased 2% and average price per item increased about 4% in that quarter three, resulting in an overall 5% decline in sales. And then moving into quarter four, we started to see much more sort of green shoots of positivity. Traffic was more or less flat. Sales conversion recovered from where it was in quarter three to only be down by 2%. And the price impacts of 2% continued to flow through, resulting in sales being slightly down at minus 1% and resulting in the strongest quarter we saw of the entire year. And then drilling into the quartile performance of retailers. So what we did was we broke down what were the top 20% of retailers in terms of sales performance versus the middle 50% and the bottom 25% within that. What you can see there is some sort of quite interesting trends. And when we look at the mix of these retailers that are in that top quartile, there's a slight skew towards health and beauty. That was certainly an area of sort of strength as the overall sort of health and well-being macro trend of consumers flowed through, and we also saw that reflected in activewear with consumers as well. But there was a cross-section of retailers across a range of different product categories represented in that top quartile. So it wasn't just a story of where you just happened to be in the right category, and that drove high performance. It was clearly a case of retailers who were getting all of the levers right and getting the basics right around their store performance and that customer path to purchase that were able to get into that top quartile group. A couple of key observations of where those top quartile retailers made the difference in terms of their overall performance. Clearly, they were in the right locations. We saw 9-10% declines in passerby traffic across the middle and the bottom quartiles, but despite an average 8% decline across the market, those top quartile retailers were able to hold passerby traffic in line with the previous year. From a shop front conversion perspective, actually the top quartile performers were the weakest of the three groups in converting that passerby traffic into store traffic, but it wasn't a sort of a huge differentiator across the different groups. What really showed through though is once the customer was in store, top quartile retailers were much more effective at being able to engage and convert that customer into a sale. So sales conversion was up 1% against declines across the bottom and middle sectors, and similarly average transaction values were also able to be grown along with the sales conversion. If we look at that in-store performance in a bit more detail for that middle 50%, you can see that group was able to sort of hold price and potential price increases that they might have been pushing through, but it did seem to have an adverse impact on overall sales conversion with a 5% decline there. In the bottom quartile, they weren't able to even hold average transaction values, whether through discounts or promotions or other mix factors. It drove an overall 3% decline in their transaction values, and despite overall price declining, they weren't able to even hold sales conversion of those customers either, resulting in a 2% decline. So we saw quite a large spread there of 18% sales performance difference between the top quartile performers with 8% growth year on year versus those bottom quartile performers that had a negative 10% growth year on year. So drilling in a little bit more detail behind those sort of national figures, when we looked at states, Queensland was the sort of strongest state in terms of traffic performance, pretty much being flat on last year. And South Australia and Tasmania were the weakest in terms of traffic performance, down 4% and 13% respectively, which broadly aligns with overall population growth trends. So, WA and Queensland are relatively strong in terms of their overall population growth at the moment, and South Australia and Tasmania are two of the weakest states in terms of that performance. So that sort of is flowing through in what we're seeing in overall traffic performance as well. One of the more sort of interesting observations and somewhat counterintuitive, given the cost of living pressures that we're all facing at the moment, is that higher ATV retailers actually had the lowest decline in foot traffic year on year. So retailers with more than $150 ATVs were flat. Low ATV businesses under $75 were down slightly, and those sort of retailers that are sort of in that middle band of 75 to 150 actually had the highest declines in foot traffic. So it's clear that there's definitely pockets of consumers out there that still have money to spend and are willing to spend in more sort of expensive and premium brands and product categories. And we think, part of the driver of that is the baby boomer group. Clearly, with higher interest rates, self-funded retirees are going to benefit generally from that, and that's going to sort of help some of those more premium retailers. Looking at different retail precincts now and regions, you can see on the left, metro, capital city areas and regional areas were roughly similar in performance, down about 1% in traffic. CBD locations, though, were a bit worse hit, down 3%. Again, reflecting, increased hybrid working. People are spending less time of their working week in offices in CBD locations, as well as, the flagship locations now we're seeing in much more the sort of super suburban shopping centres. And so some of the reasons why people might go into a flagship store in a CBD location of the past aren't quite as strong traffic drivers as what they have been. And we see that a bit when we drill down into the metro locations in the middle chart there. Outlet locations were the only precinct where we saw foot traffic grow year on year, up 2%, as more sort of value-seeking consumers shifted more into that channel and out of some of the full price shopping centre channels. But we also saw larger super centre shopping centres, the likes of Bonsai Junction in Sydney or Chadstone in Melbourne, have lower foot traffic declines compared to major and minor shopping centres, which were down around 2%. Again, we think the super centre traffic is, very much focused around flagship stores that are going into those locations, and a lot of refits that are happening, which are creating, more of a retail experience for consumers and helping to maintain some foot traffic strength in those locations. Regional locations, there wasn't as much of a distinction between outlet centres and shopping centres in terms of traffic performance, but you can see both regional and metro street locations were quite heavily impacted in terms of decline in foot traffic year on year, as people tended to gravitate more towards the larger shopping centres. And then finally, in terms of these sort of slices, the product category view. On the left, we've got a view of what foot traffic, inside store foot traffic, did by product category, and on the right, we've got a view of what sales performance did for those categories. One of the quite interesting observations out of this, what we've highlighted, is that health and wellbeing sector, so health, beauty, wellness, and active wear, was actually the weakest in terms of inside traffic performance, down 4 to 6%. But they were able to really convert very well for the foot traffic that they did have in store, both in terms of the least decline in sales conversion. So they weren't able to grow sales conversion, but they had the least declines in sales conversion compared to other categories. But they were able to grow ATV about 3 to 4% on average, which meant that they actually became the highest performing sales product categories, despite having the lowest foot traffic performance. Probably the other call out on here is homewares and Manchester. So you can see they had also relatively weak foot traffic, but that they weren't able to translate that into sales either. So 6% decline in sales as a more sort of higher cost purchase and probably more discretionary and delayable purchase as consumers sort of really looked after what their wallet. We also looked at performance for key retail selling periods through the second half of the year. Easter on the left there and Mother's Day on the right. Both were quite weak in terms of overall performance. You can see Easter was down 9% year on year in sales when we look at the 2-week window around the Easter weekend. And similarly for the Mother's Day week, we were down 7%. A lot of that really was driven by traffic in both those events. Foot traffic was down about 7% for inside store at Easter. We did see it down more in metro areas and less in regional areas, indicating that people were heading away for the long weekend and spending more time in regional locations. But overall traffic was well down. And for Mother's Day, traffic was down about 6%, which drove a large proportion of that 7% decline in sales. And we saw a shift in spending patterns as well. Consumers were more sort of value seeking, and while watch and jewellery remained popular, other categories like health and beauty and activewear were more popular than they had been the year before. And finally, in terms of our FY24 review, the good news is we saw some positive shift in momentum over the latter part of FY24 and leading into the start of FY25. There was a consistent upward trend starting around mid-May and continuing on through in terms of foot traffic performance as well as sales performance. And through July and even into August, we're seeing, growth or at least broadly flat performance year on year, which is encouraging for the year ahead. So moving on into the FY25 Outlook, what do we think could happen over the next 6 months? So we've broken our analysis down into first quarter trends and then second quarter trends. In terms of first quarter trends, you can see there on the far left of the graph, and as I mentioned before, quarter one of FY24 was the weakest quarter of the whole year. Traffic was down about 4%, sales was down around 7%, and given the positive momentum that we're seeing, combined with positive influences like the stage 3 tax cuts injecting $20 billion more into people's wallets, the increase of award wages from the 1st of July of just under 4%, and certainly it would appear reaching the bottom of the interest rate period and sort of upside improvement for consumers in terms of interest rate cuts, hopefully, within the next 6 months. So from a traffic and sales perspective for the first quarter, taking those things into account, we think there'll be certainly a rebound on the weak quarter the year before, somewhere in the order of, flat to up 2% for both traffic and sales. As we move into quarter two and move into that Christmas trade period, we think that there will be, again, some recovery on what we saw in quarter two FY24, but not as significant a rebound as what we will see in quarter one. So they're probably somewhere in the order of up 1% to up 4% in terms of traffic and sales in quarter two. So there's obviously quite a bit to sort of digest there within the trends that we've shared. But from our point of view, if there were sort of 3 key takeaways that we think are probably the most impactful actions to think about in the year ahead, it really breaks down into thinking about store location, thinking about planning for key events, and thinking about how do you optimize and maximize sales conversion within your stores. So from a store location perspective, as we saw with those top quartile retailers, making sure you're in the right locations so that your passerby traffic is as robust as possible. Looking at making sure you're in the right location within those centres, not just in the right centres. When we look at foot traffic between sort of hot spots and cold spots within centres, it can vary by up to sort of 50% plus. So making sure you're in the right location within a centre is almost as important, if not more important, than being in the right centre in the first place. And then finally, thinking about, for your brand and your business, what's your channel strategy around outlets? They're clearly a sort of growth segment from a foot traffic and sales perspective over the last 12 months, and we expect that to sort of continue moving forward. So thinking about what role that channel plays and what overall mix it has within your portfolio, we think is an important strategic question. From a key events perspective, those events can obviously make or break the year. For example, Black Friday, we typically see about 100% uplift in sales compared to an average week. So it's almost like you're creating an extra week of the year within your retail calendar. So getting the planning right for those is really critical, and obviously Christmas as well. And as Kylie mentioned in the introduction, we've just released a brand new ebook, which looks at the Black Friday trends of last year and what the insights and implications and lessons learned for this year. And we'll make that available for you to download following this presentation. Finally,
Excellent.
then.
Oh, sorry about that.
There we go. And then finally, just sales conversion. As I mentioned in the opening remarks, it was the biggest driver of the overall sales decline we saw for FY24 year. So, you know, a lot of our retailers we know are putting a lot of focus on that, and we think that's right. But ensuring all of the different getting retail basics right that drive sales conversion is important. So have you got the right products? Have you got the right stock availability? Are staffing levels right in your stores? Have you got the right investments in coaching and training? And finally, have you got the right consumer experience in store to maximise the overall purchase funnel?
Excellent. Thanks for that, Denny. I'll try not to interrupt you again next time. So for those who haven't seen it, we've already shared the pop-up in the bottom left-hand corner of your screen. So if you click on it, it'll take you through where you can actually download the ebook. It's the first time that we've done something like this, so I'm sure you'll enjoy reading it, and might be something that you can share with your wider leadership team as well. Look, a couple of questions just to sort of round out what you've showcased today. So one of the ones I had to ask was, we've seen inside traffic results over the last 6 months be relatively flatline, and things have started to really sort of turn around. I'm keen to know, like, what's your view on what's driving this improvement in traffic and some results across some of the sectors?
Yeah, look, I think if we roll the clock back a year, the sort of macroeconomic conditions were pretty bleak, and the outlook was pretty bleak. Consumer confidence was well down, and people were, pessimistic about their household budgets for the year ahead. And I think that resulted in a pretty weak first half in general. I think as we've progressed through the year, there's a little bit green shoots of more confidence. It's still fragile, but it's unlikely interest rates are going to increase. If anything, they're going to start to decline. Inflationary effects are starting to come back closer to the target RBA range, which is a positive. And then we've had positive, policy announcements around stage 3 tax cuts that have now flowed through. Similarly, award wage increases that have flown through. And so I think people are starting to feel like they've got through the worst of it, and there's a bit more positivity going forward. So I think that's what we're starting to see reflected in the numbers that we're seeing week to week.
Great. And we've got a question in the audience before I finish up with my last question. So from Dan, he's interested to know, when will electronics be added to the Kepler KRI?
Yeah, great question. So we certainly want to make as many product categories available within KRI as we can, but we also, want to make sure that the anonymity of all of our clients is also protected within that. So we have some very sort of stringent guidelines around how many stores and how many different customers we need within a category to do that, and we review that on a 6-monthly basis. So hopefully we should be able to be in a position to do that within the next 6 months. I'd certainly like to include that in the KRI moving forward.
Yeah, and we'll always announce that as well to our customer base once those changes have happened as well. I know we did recently make some additional, quite a significant improvement in our KRI data set as well. So we recently announced that, I think, a couple of months ago too. And look, finally, unless there's any other questions in the audience, I wanted to know, why do you think the high ATV or high basket spend retailer has not been as impacted as much as the lower end of the scale?
I think there's probably a couple of factors. So one, I think there's a little bit of sort of small treating, small luxuries. People are sort of not investing in some of those larger sort of household purchases, like, you know, TVs or furniture, but are sort of those smaller luxuries of I'll get a new perfume, or I'll get some new activewear, or those types of investments. So I think that's helping to sort of prop up some of that, you know, 150 plus ATV traffic and performance. I think there's certainly segments of the community that have not been anywhere nearly as impacted by the cost of living pressures and the mortgage rates. You know, people who don't have a mortgage and self-funded retirees, as I mentioned. So I think they're helping. And I also think, you know, when we look at the trend, those sort of middle ground ATV customers, they've been the ones that have been hardest hit. So people are sort of either picking, I'll down trade to seek value, and I'll go into that sort of lower price point to meet my needs, or I value a brand or a particular category, and I'm willing to invest a bit more to get you know, a higher quality product. And I think it's that sort of middle ground that's probably the most challenging, and what we see through the numbers, where it doesn't offer a great value, but it doesn't necessarily offer some of that you know, higher brand premium that we see.
Fantastic. Well, thank you for sharing your insights today. For everyone that's in the audience, if you haven't downloaded the Black Friday ebook, do so now. And it's on the bottom left-hand side. And as always, we'll share today's presentation and recording with the audience as well. So you'll hear from us very shortly. Thanks, everyone, for your time. And we look forward to seeing you again shortly in our next webinar. Take care, everyone. Bye.
Bye for now.